Man, trying to get a clear read on the US economy right now, it feels almost impossible. You've got conflicting headlines everywhere, a tech sector that's all over the place, and really mixed signals from consumers. So what's the real story behind all the noise? Let's dig in and see what we can find. All right, so let's put on our detective hats for a minute. The big question we're all asking is the US economy genuinely strong, or are we just missing the signs of a recession right around the corner? In this explainer, that's exactly what we're going to do. We'll follow the evidence, connect the dots, and see if we can build a coherent story. So our investigation starts in this really uncertain environment. You've got the tech world, especially everything AI, just on a total roller coaster. And then you look at consumers, and it's like a tale of two cities, right? The wealthy are spending, but a lot of families are really having to watch every penny. It's this messy, murky picture that makes the latest data we're about to look at so important. These are our first real clues. And our first piece of evidence, it's a huge one. It's a major win on a front that has basically dominated every single economic conversation for the last few years: inflation. Okay, look at this number right here, 2.4%. That was the headline inflation rate for January. And what's wild is that it didn't just beat expectations, it's the slowest inflation has been since way back in May of 2024. So this isn't just some small blip, it's a massive step forward in the fight to get prices under control. So why is this such a big deal? Well, from a certain economic point of view, particularly a more conservative one, getting inflation under control is, well, it's pretty much goal number one. It's seen as the bedrock of a healthy economy. I mean, think about it. When prices are stable, your savings actually hold their value, and businesses can plan ahead without worrying about what their costs are going to be next week. It creates stability. Okay, so let's move on to our next clue. If step one is taming inflation, then step two has to be figuring out where the real strength of the economy is coming from. And to do that, we have to look past all the noise and the flashy headlines and dig into the sectors that actually, build stuff. We're talking about housing and manufacturing. Just look at this number, 1.404 million. That's the annualized rate of new homes being built back in December. And this is with mortgage rates being so high. This figure absolutely crushed what everyone was expecting. You gotta remember, housing is what we call a bellwether. It's a huge signal of consumer confidence, and it kicks off a whole chain reaction of economic activity, from lumber and concrete all the way to furniture and appliances. This tells us a key part of the economy is way stronger than a lot of people thought. And get this, it wasn't just a high number. It was growing. Housing starts jumped by a whopping 6.2% in a single month. That's not just things holding steady. That's actual, real acceleration, especially in a sector that a lot of folks had pretty much written off. So you can see the case for a resilient economy is definitely starting to build. And it just keeps coming. As you can see right here, the evidence is really piling up. It's not just housing. Look at industrial production for January, up 0.7%. That's almost double the forecast. Manufacturing, same story, beat expectations. And even building permits, which are a great clue for what's coming down the pike, came in really strong. When you put all this together, you get a picture of a surprisingly tough, robust industrial core. But, every good mystery has a twist, right? Just when you think the case is closed, that the economy is resilient, you find a clue that just doesn't fit. And for us, that clue is the labor market. It is sending some seriously confusing signals. And this slide just lays the puzzle out perfectly. On the one hand, the good news, January added 130,000 jobs. Looks great, right? But then, the bad news, and this is a bombshell. The government went back and revised the data for the last couple of years, and poof, over 700,000 jobs that we thought were created just vanished. They're gone, wiped from the record. I mean, that completely changes the narrative, doesn't it? So what in the world is going on? Well, economists have a term for this. They're calling it a low-hire, low-fire environment. Basically, it means companies aren't doing big layoffs, which is obviously good, but they're also not really hiring anyone new with any confidence. It's like the whole job market is just treading water. It's stable, sure, but it's not growing. And that really throws a wrench in our nice, simple story of a booming economy. Okay, so now we have our case. We've got strong evidence for resilience on one side, but a huge red flag from the jobs market on the other. So how does the ultimate judge and jury of the economy, the Federal Reserve, interpret all these conflicting clues? Let's see what the verdict is.
And here it is, the final piece of our puzzle, straight from the Fed's January meeting minutes. You can see they're definitely concerned about inflation progress being slower and more uneven. They basically think the economy is strong enough that they don't need to rush to cut interest rates. And this is the real kicker. Some members are even talking about potential future rate hikes still being on the table. Wow.
So what does this all mean? Well, weirdly enough, the Fed being so cautious is actually a sign of confidence in the economy's core strength. Just think it through. If they thought we were headed for a cliff, they'd be shouting from the rooftops about cutting rates to get things going again. The fact that they're holding firm and even whispering about hikes tells you they see the same powerful resilience in housing and manufacturing that we've been looking at. Okay, we've gone through all the evidence, we've heard the verdict from the Fed. Now it's time to put all the pieces together and build the actual narrative for a resilient U.S. economy. So here it is. Here's the story you can build from all this evidence. A narrative that lines up pretty well with a conservative economic view. First, inflation is largely under control. That's a huge win. Second, the real economy, the part of it that actually builds houses and manufactures goods, is surprisingly strong. Third, because of that strength, the Fed is justified in being cautious and not intervening too much. And the final result of all that? A stable, resilient economy that doesn't need a bunch of help. But, and this is a huge but, we have to remember that one piece of evidence that doesn't fit. This is just one way to interpret the data. That underlying weakness in the jobs market, with those 700,000 ghost jobs that just disappeared, that's a massive counterargument, and you just can't ignore it if you're looking at the whole picture. And so that leaves us with this final, really important question. It kind of feels like we're living in two different economies at the same time, doesn't it? You've got the strong, industrial, real economy on one side, and a much weaker, uncertain job market on the other. So the question for you is, which one of those two stories is going to define your financial future?